Evelina here, coming to you in my amazing blue today to talk about this mortgage waiver and the cash out refinance to pay down your student debt. I want to talk about what is the program, and then I also want to break down and talk about the pros and cons of the program, right? When you originally hear about a program where you can use the equity in your home to pay down your student loan debt and therefore pay a way lower interest rate, it sounds really appealing. But I also want to directly name the pros, the cons, the good and the evil of the program, so everybody can make that analysis based on their specific circumstances. So let's dive in. First, what is the program? This mortgage waiver program is it's an opportunity by Fannie Mae in which the program guidelines say that if you are a student loan borrower or you hold the debt, which means you signed like Parent Plus loans, for example. So if you're a parent and took out loans for your children, as long as you are named on the mortgage loan as well as on the student loan, and it's your primary mortgage, you can take cash out to pay down that student loan debt if the money goes directly to the servicer and that the loan is paid in full. So just to specify, let's say you have $40,000 of student loans, but they're broken up into many loans. As long as you pay off an entire loan and not partially pay one loan, it doesn't mean that you have to pay all 40 grand. It just means you need to pay the entire loan of that one loan, right? I know sometimes for undergrad and grad school, you can originate multiple loans for every semester. So just to specify those rules, it has to be your primary mortgage. You have to be named on the student loan directly. So you couldn't refinance, take cash out to pay down your child's loan. It has to be a loan with your name on it, and it needs to pay specific loans off in full. So recap of that. So this program, people on the surface, right, think it's great because they're like, oh my gosh, I have a Parent Plus loan. It's 9%, 8.5%. And now I could use the equity in my home, take the cash out, refinance, and get it at 3.5%. So I'm taking that 5% reduction. And that sounds great. That might be the right opportunity for you. But I want to spend a few minutes to talk about the pros and the cons of this mortgage program. A pro, if you are, for example, someone that has built up quite a bit of equity, you're earning significant amounts and the amount of debt you have is low, or you have a pretty low student debt to income ratio. Let's say you have $30,000 of student loan debt and you earn $100,000 a year and you just want to pay down the student loan debt and you want to refinance anyways. Maybe you're a prime candidate for this because you have a stable, high salary. You could pay off your student loan debt. You are not at risk you're not at risk of not being able to make the payments, or you have a stable job. Those are all scenarios under which you may be a great candidate for this cash out refinance, pay down your student debt, right? You don't work for a nonprofit. You're not going to get forgiveness. You're in a financially stable place and you want to pay a lower interest rate. You were going to refinance anyways, and you don't want higher interest student loans. And you could just wrap your student loans into your mortgage refinance and not have to consider refinancing your student loans separately for a higher interest rate. You could just wrap it in here, right? So those are the conditions. And you're not worried about needing disability discharge. You're not worried about losing your job. You're not worried about possibly having to default foreclose on your house. You're in a financially stable situation, and it just happens you want to lower the interest rate and you're not going to get forgiveness. Then this program may be great for you, okay? But for the average person who's struggling to make student loan payments and you've built up some equity on your house, maybe this is not the best option for you because you benefit from federal protections, right? The pros are it definitely can allow you to get a lower interest rate on your student loan. That is for dang sure. Not always significantly lower. It just depends on what your student loan interest rate is, right? Because if you took out student loans for your undergrad and you want to use it for your specific student loans, but let's say your student loans are only 4.5% or 4%. And by doing this, you're only going to get a 3.5%. Well, maybe that's just not worth it. The second thing that makes it maybe not worth it is if you're a candidate to get on income-driven repayment and you're a candidate to get your loans forgiven. If you're a candidate to get your loans forgiven, this may not be optimal because you could get a significant amount forgiven, in which sometimes people don't end up even paying back what they borrow, let alone all the interest. So if you're going to get a significant portion or any portion of your student loans forgiven, understand the full effective interest rate, because if you pay back less than you borrow, you're getting a negative interest rate, which refinancing your mortgage to take out money to pay down your loans may not be a good decision at all. Okay. So those are a few circumstances. It's just understanding what is your ultimate payoff with income-driven repayment if you're going that route versus what would your ultimate payoff be at a lower interest rate, right? Because oftentimes people only think of student loans as like, 8% versus 3.5%, but they're not thinking about what their effective rate would be, including loan forgiveness. And for a lot of people, that may be close to 0% or even negative because they're not going to end up even paying back what they borrowed, okay? For a lot of Americans, that's the case. So understanding effective interest rates and not just advertised interest rates, they're different. Okay, so those are some of the cons. Other cons, of course I'm making this video because you hear the pros oftentimes from lenders, and I want to provide that counter view, okay? Just to make sure you're making a very educated decision, okay? Another counter view, maybe you're turning a 10-year loan or possibly a 20-year loan, and you're wrapping it into a cash out refinance for a 30-year mortgage. So you're effectively extending the length that you're paying back the debt. So keep that in mind as well, right? Just understanding those years and those terms thoroughly. Another thing is with the student loan program, there are federal protections that you would be foregoing. Like there's disability discharge, right? If you lose your job and can't pay, you can get on a $0 payment, right? There are things and protections you get in federal student loan programs that you're not going to get by refinancing, taking cash out to pay down your student loan debt. You're not going to get that. If you lose your job, you still have to make your mortgage payment. If you can't make your mortgage payment, they may foreclose on your house. And now not only do you forgive that student loan protections of being able to get the $0 interest, but now you may lose your house and go into foreclosure and not even have a place to live, right? So just keep in mind that there are federal protections that protect you from having to pay more than you can afford. And if you default on your student loans, at the minimum, you're not losing your home. You may end up in wage garnishment. There may be many bad things that happen to you, but at least you have a roof over your head, right? So those are some of the factors. Of course, if you need a full analysis done for you, we have advisors on standby. Just know that every decision is very personal. It's not blanket, everything is good for you or everything's bad for you. It's not blanket, this has a lower interest rate than that must be better. It's like, no, what are you foregoing to get that lower interest rate, right? And sometimes it's worth paying a little more for options, and that options could be you may become disabled, you may lose your job, you may whatever, and then having the protection of getting a $0 payment, right? So you're paying for that protection in a slightly higher interest, or maybe you're just going to get loans forgiven and you're not even going to benefit from having to pay off you're not going to have to pay off the entire amount, in which case this program doesn't make sense. The full analysis can be done for you. Our advisor's on standby, and I hope I was able to provide you with an overview of the programs. You can definitely get started on a free analysis. Links are below.